Hi, everyone. So I wanted to quickly review, sorry, I wanted to quickly review some of the work I asked you guys to do last week. As I was looking over your assignments, looks like some of us had some issues trying to pick out some of the really important details about where can I put my money and what type of account should I open. Um, so, out of all of these options you have here that I asked you to look at, where should I keep my money? In a piggy bank, in a checking account, a savings account, something called a certificate of deposit, and a money market deposit account. I wanted to quickly just review the major things you should know about these accounts. Um, as the questions that I gave you focused on, they looked at these four items. Do you have access to your money? And how do you access your money? What tools do you have available to you so I can get my money out of my account if I wanted to? Number two, do they pay you interest? Not every bank account comes with interest. Does it? Some of them do, some of them don't. And then how much interest should you expect? Every bank's going to be different, but what's a typical range of interest that I can expect? Fees, what fees are associated with this account? Some of these accounts have lots of fees associated with them. Just want to be aware of them before you go forward. And is there anything else that I should know about the account? Anything else that's unique or different about this account? Okay. First was the piggy bank or a shoebox under your bed or just keeping your money at home in, in anything other than a bank account. Sure, it's really easy to access your money. In this case, you can just open up the bottom of the bank account, the piggy bank, or smash it if you're not really uh, that tied to your bank account. Excuse me, to your piggy bank. But by taking your money and just putting it into a piggy bank or in a shoebox, you will earn no interest. The $200 that you got for confirmation from your grandmother that you put into that piggy bank now, 5, 6 years later, is still $200. It has not done anything for you there. It has not grown, so you get no interest. Sure, there are no fees because you don't charge yourself fees. And there's really nothing exciting about this. If you are keeping your money at home in a shoebox or a piggy bank, you can do so much better than that. You're wasting your time and you're really not being very smart about where you put your money. One of the other things about this is that no insurance policy is going to cover you in case something happens. If someone breaks into your house and steals your piggy bank, you could claim to the insurance company that you had $4 million in the piggy bank, and they're probably not going to cover you for it. So there is no protection by keeping your money at home in a safe, in a piggy bank, in a shoebox, under your mattress. So there really wasn't a lot to look at with the piggy bank. Next are checking accounts. When we talk about checks, we are talking about what we call a negotiable instrument in finance terms. This is almost like a cash substitute. A checking account is defined as it's an unconditional written promise to pay a specified sum of money as of a specific date to a very specific payee or bearer. I promise to pay this amount of money to this person on this date. So that check you write could possibly substitute for cash in a lot of areas. Okay, we're going to come back and talk a lot about checking accounts when we're done here. So what does that mean for you? How do you access the money in the checking account? Typically, you have a lot of ways to get your money out of a checking account. Checks are the first way. A lot of you totally blew past checks in your assignment there. Write checks. We'll show you how to do that if you don't know how to do that later. That's essentially, in most places, the cash equivalent. Online banking. You can do a lot of things on your bank's website now to be able to even pay bills, to send money to other people, all out of your checking account, which is really nice. Debit cards. We talked very, very briefly about the difference between a debit card and a credit card. A debit card, here's mine, a debit card is basically an electronic check card. It is tied back to your checking account. Anywhere that I could write a check, I could just swipe my debit card and take the money out of my checking account as if I was writing a check. We'll come back and talk about this here in a second. ATM access. You can take money directly out of your account via an ATM. Great. In most cases, checking accounts do not pay interest in most cases. Some banks have specialty checking accounts, which with a couple of other restrictions, you could potentially earn a little bit of interest on your checking account. But let's assume for our discussion here that checking accounts don't offer you interest. Okay. If they do, it's very, very small amount. Checking accounts in some ways are notorious for fees. Some checking accounts require you to have a minimum deposit in the account. You need to have at least $100 in the account. And if you don't, they charge you a monthly fee just to keep the account awake and alive. Some checking accounts have restrictions on the number of checks you're allowed to write. In some cases, you need to write a certain amount of checks every month. That one's not so popular. Monthly maintenance accounts are popular, though. Just to have the account and to take care of some of the administrative fees associated with keeping the account open, there might be a monthly fee, $4 a month or whatever. I'm making that number up, but we can probably look for some averages if we needed to. We'll talk later about this concept called bouncing a check, and there are all sorts of other issues and other things you can ask them to do with your checking account, and often they come with fees. Okay. Your account is protected. You do have a bit of insurance with the bank, not only the bank's own security, but you do have some insurance with the bank. I'll get to that at the end after all the accounts here. So those are some of the major features of your checking accounts. Not a lot of interest, if any, and lots of different ways to access your money. Savings accounts. Savings accounts, access to money, very similar to the checking account, except you typically cannot write a check out of your savings account. You can access it via an ATM. You can take money out of your savings account on an ATM. If you swipe your debit card at a cash register to pay for something, it'll often ask you what account. If you have multiple accounts at the bank, it'll ask you which account would you like me to take the money out of, checking or savings. So you can take your money out of the savings account with your debit card. And you can often, if you have multiple accounts at the same bank, you can actually move money between the accounts through online banking. So if you had some money sitting in your savings account that you wanted to spend, you could take it out of your savings account, put it in your checking account electronically. You just don't have the ability to write checks out of it. Savings accounts will offer you some interest. Unfortunately, at this point, the interest I think you're going to find is maybe a 0.5 percentage point, 0.5% to 1, maybe 1.5% if you're lucky, as of this date right now in 2020. You might have more options in the future, and we'll talk a little bit about why are these account interest rates not great right now. But it's better than nothing. It's better than the piggy bank. Fees, there are some of the savings accounts do have monthly fees just to keep your account active, and some of them have limits on the number of times you're allowed to take money out of the account. It's designed to help you save. So in some ways, to kind of save you from yourself, banks will impose limits on how much money or the number of times a month you're allowed in your savings account to take money out. They're trying to help you save. Your account is also protected through your bank. There's some insurance that your bank has, which we'll talk about here in a little while. Certificates of deposits was the other one I asked you guys to look at, which is probably a different account that not a lot of you have really heard of before. The key part and the key concept here with CDs is that CDs involve investing your money in this account for a set period of time. So you put your money in, and in theory, you can't take that money out of the account until the end of the period you signed up for. You will typically set up your account, and you will agree ahead of time on how long that money will sit in the CD. What are we talking here? 3 months, 6 months, 9 months, a year, 2 years, 5 years, 10 years. And then based on that, however long you want to keep the money in, they'll assign an interest rate to that. So we agree ahead of time, you'll keep your money with us for 6 months. And at the end of 6 months, you can get your money back plus some interest. That time when your CD comes due, basically, right, when your certificate of deposit is up, we say that it has hit its maturity date, when the CD has matured. Okay, so when you want to put your money in there, you're going to leave it there until the maturity date, and then you can take it out plus some interest. Okay. When you buy in, you lock into an interest rate. So if they're offering you 1.5% right now, when you buy in, you are guaranteed to get 1.5%. It's a good and a bad thing. If CD rates, interest rates drop, you bought in at 1.5%, so you can't be taken down from that. Right? You have to be in there at 1.5%. Okay. So if it comes down, no, I bought at 1.5. The reverse is also true. If you buy in and it's only they're offering you 1%, and all of a sudden now they raise it to 1.25, you can't go back and now get the new interest rate. So it's a give and take there. The money needs to stay into the account for the duration of the CD until it matures. If you take it out ahead of time, there will be big penalties in place. Big penalties. Flat fees or a percentage of your deposit gets taken by the bank if you take it out early. Okay. There's a term, I'll come back to this in a second. There's a term in finance called liquidity. Liquidity means how fast can you turn an investment into cash? How fast can something be turned into cash? Some things we invest in are very liquid, we say. They're very easily turned into cash. Either they are cash, cash is the most liquid thing you can have, but then some things can very easily be turned into cash within a day or so. Stocks and bonds, you can say, we're not really going to talk about this too much. Checking accounts are very liquid, savings accounts are very liquid, and money market deposit accounts are very liquid. CDs, I'll put in the middle. Because you have to wait a certain amount of time, which could be the minimum 3 months or it could be 10 years, you don't have a lot of access to that money. So it is harder. So we're going to kind of put that in the middle of like sort of liquid. I saw somewhere described that collectibles, like a stamp collection or the bobblehead collection you have or the comic books you collect or whatever, that's a little harder to convert into cash. Could you sell it? Sure, but it's not quite as easy as these are. Things that are not liquid at all are very difficult to turn around. Things like land, real estate, buildings. Can you sell them? Yes. Is it as easy to take your house and turn it into cash as it is your comic book or your, get money out of your checking account? Not at all. So we'll probably consider that land, real estate, buildings, those types of things are not very liquid. It is not easy to turn them directly into cash. So we're going to say that CDs, because you have to lock them in for a time period, are not very liquid. That could be a good thing or a bad thing. So the access to your money, you are going to be restricted to your money until you hit the maturity date. If you try to take it out early, you're going to pay a lot of money in fees. Interest, you will get interest on this account. And right now, interest rates are varying between maybe a 0.5 percentage point and 2%. That's not horrible in today's economy to get. If you can find a CD for 2%, great. Unfortunately, the longer you leave the money in the CD, they typically will offer you more interest. So if you want 2.5% on your CDs, you're probably going to be leaving that money in there for 5 or 10 years. So the longer you put in, the more interest they'll give you. They get to use your money for longer. Remember the rule of money? The rule of money says when you use someone else's money, you have to pay for it, right? On a CD, they have your money locked up and they get to use it and you don't. And for that privilege, they pay you more interest. There probably are going to be some fees to open the account. There's some broker fees and things to open it. And you're going to definitely pay if you take the money out early and you are insured. I'm going to come back and talk about this concept called FDIC here in a little bit. Money market deposit accounts. This is a little interesting. A normal savings account, the bank is limited on what they can do with your money while they had it. They can maybe use it to borrow loans to other people. They can pay you some interest. On a money market deposit account, the restrictions on what they're allowed to do are a little bit looser. The bank can actually take your money and loan it to other banks. They can invest your money a little bit to try to make some more money. You're guaranteed to get it back when you want it, but they have the ability possibly to be able to invest it in some other investment and savings vehicles. Money market deposit accounts. Access to money, you generally can. They will give you a checkbook associated with this account or a debit card, and you can take money out. However, two things are typical. First, the number of withdrawals you're allowed to make a month. A lot of them will restrict you to under 5, withdrawals a month. And in some cases, you have to pull out a minimum amount of money. You can't write a check out of a money market deposit account for $10. You have to write checks larger than $500. We'll check to your bank specifically, but there sometimes are withdrawal minimums. Because of all these restrictions, they often will allow you to get better interest. So it could be upwards right now today between 1.5% and 2% or more. In some cases, there's also a minimum deposit you have to have in the account in order to earn interest. And sometimes that threshold's kind of high. Sometimes you might say you need to keep $5,000 in the account in order for us to pay you interest. They don't close the account if you drop below the minimum. You just won't earn interest anymore. So it's a bit of a trade-off. How much money are you going to be able to put into this account? There are some fees that you have to set up in order to open the account, and then there might be some minimum deposit in the account requirements. If you drop below that minimum deposit, they might even charge you a fee or like a maintenance fee in order to keep that account active when it has too little money in it. You also typically need a minimum initial deposit to open the account. So I've seen that money market deposit accounts that require you to have $10,000 or more just to open the account, right? So there could be a lot of benefits to the money market deposit account, except you're talking usually on a larger scale, and you're talking about not readily accessing this money all the time. You have more access to it probably than you have a CD, but it's probably not where you're going to put your day-to-day money. Okay. All of these accounts we've just talked about, one of the big benefits to this is something called FDIC. FDIC is called the Federal Deposit Insurance Corporation. The Federal Deposit Insurance Corporation. This was created by the U.S. government in 1933. In 1933, we were in the height of the Great Depression. If you remember from history class, the economy was horrible. People were scared and were not spending their money, and banks were failing around people. Average, everyday people were doing everything right. They put their money into banks, and then the banks were going out of business and wiping out people's savings accounts and all the money they had. So the government stepped in and said, we have to protect people. We should be able to insure people if I put my money in the bank, that it's guaranteed. Okay. Right now, I'll give you a list in a second here on what accounts are covered under this deposit insurance under FDIC. As of right now, in 2020, you are guaranteed up to $250,000 per depositor per bank. So if you have up to $250,000 and for some reason your bank goes under and goes out of business, the federal government insures you. They will recover for you any money that was in that bank and lost with this insurance policy. If you have more than $250,000 in one bank, let's say you have $1 million in the bank, they will cover you up to $250,000. So some people actually have multiple bank accounts. If you have a ton of money, they'll have a lot of different bank accounts. They're all protected under FDIC. Now, luckily for us, all the different types of accounts we've talked about so far, every time I touch that, the screen goes blank. Checking accounts, savings accounts, CDs, money market accounts, those are all covered under FDIC. IRAs or individual retirement accounts, those are covered. We're not really going to get to those. And trust funds, we're definitely not going to talk about those. Other things that are not necessarily insured, a lot of your investment tools like stocks and bonds, life insurance policies, not covered under FDIC. And unfortunately, if you have a bank and you put stuff in a safe deposit box, not covered under FDIC. So if you're going to go to a bank, most banks are, but you want to probably just double check, is this FDIC insured? Sometimes there'll be a sticker on the window or somewhere in their brochure or their information, they will tell you we are FDIC insured. But luckily for us, most of the accounts that we're going to talk about here are all covered. Okay. So that is the summary of your of all the accounts you can possibly open. Let me bring those accounts back up. Okay. In the next video, or the next thing we want to look at is, well, where should I put my money? Right? Of all these options, where should I put my money? And then I actually kind of would like to talk a little bit about, why do the interest rates stink right now? Why am I only getting less than 1 percentage point on a savings account or a CD? There's a bit of a reason for it. So we'll talk about that in the next video.